Hi there, Kurt Jackson, Retirement Income Strategist with KJ Financial with our this week's installment, our second installment of a new thing we're trying. It's called Your Money Matters, where we're trying to kind of talk about, I don't know, the market, what's going on with money, things that you might need to be concerned with, maybe things that we could take advantage of. And this week, I kind of want to talk about what's gone on the last 3 or 4 weeks in the market. We saw the stock market go down 1,000 points and then come back up 1,000 points. The U.S. The 10-year bonds went down to 1.86% and then back up to 2.35%. The oil drops below $80 a barrel. Gold falls below $1,200 an ounce. Quantitative easing ends in the United States for the third time, but housing kind of continues to struggle, even though we keep hearing it's doing really well. Is the official inflation number in the U.S. 2% or so, or is the real world number 7 or 8%? Remember, I've talked about this before in many of my things, but we look at the CPI. That's what the government says, the Consumer Price Index. But they don't include food, energy, and healthcare in their inflation number. And those are very volatile things. But, if food starts to go up, are you not going to buy food? If energy goes up, are you not going to heat your house? You're not going to air condition your house. You're not going to drive your car. Healthcare goes up, are you not going to go to the doctor? So while those things aren't included in the government's figure, shouldn't they be? Right. So now unemployment's down to what? I think 5.8%. But is it 5.8 or is it closer to 15%? Because when people go through the 99 weeks of unemployment that they allow, if they don't have a job, then even if they're still looking, they're no longer considered to be unemployed. One of the things that I talk about is never believe the government statistics because they're not true, they're not accurate, and it's not the left doing it or the right doing it, it's the government doing it because everybody's done it. Why would it make a difference if unemployment's 15% and not 5.8%? That'd make a big difference, wouldn't it? All right. Alan Greenspan, our former Fed chairman, made this comment at a New Orleans investment conference at the end of October, and he said that promises made by the government cannot be kept. It's mathematically impossible. Right? So does that sound like? I know they're trying to make everybody say how great the economy is. Does that sound like everything's great with the economy? Do you know? We've talked about corrections coming. I've talked about it. We've heard about them. Economists are predicting huge corrections, market crash. Do you know when the market correction's coming? I don't. Does your advisor? Does your plan administrator, your retirement plan at work? Does anybody know? No, nobody really knows, do they? So, like I said, I don't know when it's going to happen. I just know that it's coming, and it has to, because all the things that existed in 2007 that brought us down pretty much still exist today. But would it surprise you to know that they're 2 to 3 times bigger now? And that's crazy. All the and it seems like all the central banks on the planet have joined into this printing money thing. And they're printing it as if their lives depended on it. So, I'll go back to where we talked about how this economic catastrophe is coming, but it hasn't come yet. And I wonder why. Do you wonder why it hasn't come? Do you know why it hasn't come? Well, there's several reasons. And we can start by examining our third round of quantitative easing in the U.S. Where do you think the bulk of the third round of that quantitative easing went? You probably won't believe it, but more than $700 billion of it went to foreign commercial banks in an effort to recapitalize them. Most were in Europe, and because in a very recent stress test, on those banks in Europe, 24 of them failed it. In fact, Mario Draghi, the chairman of the European Central Bank, has said on many occasions that there's no amount of money that will ever recapitalize all of Europe's or most of Europe's banks. So where did our Federal Reserve get all that money to buy all those U.S. government bonds? They printed it. Yeah. So, in fact, the balance sheet on the Federal Reserve has risen from $600 billion to $4.4 trillion. Well, what if interest rates on 10-year treasuries went up to 3%? Wouldn't the Federal, or went up 3%, I'm sorry, wouldn't the Federal Reserve's so-called asset sheet lose 30% of the value on those bonds that are there? Well, why wouldn't the Fed go bankrupt? Because most people, it would make a lot of people go bankrupt if they lost that much. No, they would just print more money. Right? We've got to realize that. See, almost all the stimulus in this country goes to banks, enormous companies, Wall Street, actually going overseas now too. And in the meantime, the middle class, the elderly, the young, minorities continue to see their standard of living deteriorate. So here's the second thing to think about. If quantitative easing is ending in the US, what's stimulating the increase in the stock market? Well, Europe, which all of Europe is the largest economy in the world, it began instituting an enormous quantitative easing in October. And Japan surprised the world and actually increased its quantitative easing to almost $3 trillion per year. See, and all this new stimulus money replaced the stimulus money that ended in the United States when it temporarily ended its quantitative easing. See, now our stock market went up because the Japanese announced this new quantitative easing. They also disclosed that they would increase their equity investments in their equivalent of Social Security from 25 to 50% of its assets. See, most of that will be invested in our stock market. And I know that sounds like good news, but is it all funny? Isn't it all funny money that is created out of nowhere? I mean, Europe and Japan are massively increasing their debt and hoping for a positive result, but it's not going to happen. See, this is just a temporary delay for this financial catastrophe we're talking about. See, to institute quantitative easing in Japan, the Japanese central bank is now buying 100% of all the government bonds issued by Japan. Think of it this way. Let's say you had a personal debt of $100,000 and you were able to print $100,000 in cash to pay off your $100,000 debt. And now you try to tell everybody who will listen that you no longer have any debt. Right? See, that's what Japan's doing, and that's what the United States has been doing. Now, why would they do this? Right? Well, here's the second most important point I'm trying to make today is you got to understand what's happening in our world right now. The major economies of the world are much more worried about deflation rather than inflation. In fact, they're consciously, intentionally trying to inflate their economies. Now, Japan has experienced deflation for over 20 years. South America is facing declining prices. Europe's deliberately battling deflation. The European Central Bank is paying banks negative 0.1% to keep money at the central bank. And this is to inspire banks to lend money rather than hoard it. The banks have decided that it's safer to pay the 0.1% in interest rather than to loan it to borrowers who could default. So it's not helping right now. Meanwhile, the United States growth rate is under 2%, and it's predicted to stay at that level or less until the end of the decade. Even China's growth rate has fallen from double-digit growth rate from over a decade to just around 7%, and it's going to continue to decline. In fact, China has the largest housing bubble in the history of mankind, and that bubble is going to burst at some point in time. See, they actually build fake cities, right, to keep their economies going. If you don't believe me, go to Google and Google ghost cities in China and read articles about it. They're building replicas of cities around the world, and nobody lives there. Right? And that's why all these governments feel safe printing all this money, because the risk occurs when growth does start to occur again, and they try to unwind all this money and all this liquidity that are in the economies before massive inflation occurs. And just so you know, that's never been done successfully. All right. So let me ask you this. Would you be more upset if you missed a 10% increase in the market, okay, and made only, I don't know, 3 or 4%? Or if the market was up 20% and you only got 13% of it? Would you be more upset with that? Or would you be more upset if you lost 30, 40, 50, 60, 70% of your money, okay, when all of this unravels? Well, think about this. How do you want to proceed with your money from here on? Do you believe me? Do you do your own research? Do you think that we just live in some Pollyanna world where the government's going to be able to take care of all this and they're going to take care of you? Right? Do you leave your money at risk of this mess happening? What happened to you in 2007 or 2009? Did you lose money? What are you doing differently now that's going to keep you from doing that? Did you lose money back in 2000 to 2002? What are you doing differently now with your money that's going to make sure that you don't lose that money when this happens again? Okay? Do you want to leave your money in those places where you lost money before, or do you want to look at alternatives that might be able to keep your money from going down? Okay? Protect that money. Is it important to you to protect your money from loss? Okay? Is it important to you to minimize your taxes? Is it important to you to make sure that you don't pay unnecessary taxes in the future? Is it important to you to have your money where the government can't, control it? They can't get to it. They can't make you, they already, believe it or not, they at 70 and a half, they already make you start taking money out of your 401k, 403b, 457 plan, your IRA. They make you start taking money out of those accounts and pay taxes on it at 70 and a half. If you don't, there's a big penalty. Could they increase the amount that you have to take out? Could they make it in an earlier age? Of course they could. Do you want your money in places where the government's going to be, where basically you have a partner on that money? It's an income tax partner, all right? It's a controlling partner. Think about it. The money you have in your 401k, if you pull it out, you got to pay taxes on it. That's fine. You're going to have to pay taxes at some point in time, but you also pay a penalty if you pull it out before 59 and a half. Those are the types of controls that the government has put on that money. And they say it's for your own good, but is it? Okay. All right. So that's where I wanted to go with today. Once again, I went a little long. I'm sorry. I'm going to try to shorten these some, but I just had so much really important information that I wanted to get out to you. So do you believe me? Go research this to see if what I'm talking about is true or not. Okay. Then think about where you have your money. Is it at risk in the market? Is it in bonds? Is it in REITs? Is it in mutual funds? Is it in, it's in equities? Is it in big, small cap, large cap? Where is it international? Is it domestic? Is it at risk? Okay. Would you prefer to give up some of the gain if they're there, still get some of it, but maybe have to give up some of it if it kept you from ever losing when the market went down? Because there are vehicles out there that'll do that. You won't hear about that from your traditional people. You don't have those available typically in your 401ks, but they're out there. So do you want to find out about those? Would it be better to find out about those before the market crashes again, or do you want to wait until after the market crashes and begin to think about it? So if you'd like to talk about those things, explore those things, you can get a hold of me. My direct line is 816-582-5532, or email me Kurt, K-U-R-T, at kjfinancialonline.com. If you found value in this, please share the link with friends, family, anybody you care about, anybody you work with. It's valuable information that we all need to know. I'm trying to kind of keep it from being so non-technical. I know there's some technical terms I threw in there, but I'm hoping to make sure that you better understand this. So these are the questions that you need to ask yourself. Okay, and you need to get the right answers to. So go talk to your advisor, ask them what they think. See, how are they protecting your money? Talk to your plan administrator. Who do you talk to there at work for retirement plan? How can I make sure I'm protecting my money? See if they have valid strategies for that. If they don't, then call me and we'll see what we can talk about. So, thanks for tuning in. I hope you enjoyed the show today, and give me your feedback, anything, thoughts, concerns, questions, anything like that. You can also do that too via email. Thanks for tuning in.